Well, it is monthly Q&A time here yet again on the channel. A couple of days ago here on YouTube, I put up a community post to collect your questions for this video. So thank you to everyone who did ask one. If you're interested in getting a question potentially answered in a future Q&A video, just keep an eye out for my community posts here on the channel. You should be able to turn notifications on for the channel. That way you'll be notified anytime I upload a video, but also anytime I put up a new community post. That's where I always collect the questions for this video. So be sure to get in quick next time if you want to get a question answered. But if you enjoyed this video and haven't subscribed to the channel already, please be sure to do so. And without further ado, let's answer some of your Q&A questions. First question here from Jack. What do you consider to be the biggest risks for HIFS, which is Hingham Institution for Savings, in the short and long term? Yeah, sure. Of course, anytime I talk about individual stock on the channel, please do your own work on it, not investment advice or anything of the sort. But in terms of Hingham risks in the short and long term, in the short term, I think the big elephant in the room is simply interest rate risk. So Hingham runs a very liability sensitive balance sheet at the bank. Basically what that means is when their costs of funding change, so if interest rates go up, they're forced to pay higher rates on Federal Home Loan Bank advances, on money that they borrow there, and also they're forced to pay higher rates on just customer deposits as well. Those rates change very quickly if interest rates go up, so their costs immediately can rise, but also if interest rates go down, their costs pretty immediately fall on that kind of funding side at the bank. But there's quite a lag for those same interest rates and yields to change on the asset side. So for Hingham to earn more money or higher interest rates on the loans and mortgages and so on that they write, typically on commercial and residential real estate. So that kind of timing mismatch does create some risks and some opportunities. It worked really well for them during COVID, for example, when interest rates got cut really fast. A lot of their costs dropped out while the yields they were getting on their loans was kind of slower to come down. So they earned a lot of money through that period of time. But in the last year or so, as interest rates have come up reasonably quickly, the costs of funding at the bank have gone up a lot, and they've struggled to kind of pass those higher rates through at the same pace on the asset side. So in the short and even medium term, I think that's a pretty big risk at Hingham and something to watch very closely. In the long term, assuming kind of the yield curve normalizes and interest rates are relatively stable over time, it doesn't really matter, I don't think, if they stay high or if they stay low. It's just kind of the rapid movement can cause weird stuff for Hingham. Assuming that they're reasonably stable over a long period of time, I think in the long term some of those risks will alleviate. It's just, you know, if rates stay at these levels for a few years, it might take Hingham some time to correct, potentially a couple of years. We'll just have to kind of wait and see how that looks. In the long term, there's a lot of things I think to really like at Hingham. They have very low cost operations and they have great management of credit risk. So very few of their loans tend to become non-performing, for example. But they do have, you know, some key man risk and so on. There's a couple of people at the bank from the Gorgon family that are big owners of the bank and make a lot of management capital allocation decisions. If something were to happen to one of those people or they were to move on to something else, that's sort of a long-term risk on the qualitative management side as well. So again, do your own work on the stock if you're interested in it, but those are a couple of thoughts on risks, short and long-term for Hingham. Next question here from Gage. Hey Tom, do you reinvest your individual stocks dividends? I would guess not, because you wouldn't want dividends reinvested at overvalued prices, but maybe I'm wrong. Yeah, sure. A couple of different sort of categories of investments for me personally. With some of my ETF holdings, which are just long-term holdings of index funds, essentially. Those do have dividends just set up to automatically reinvest and buy more of the index through the couple of different ETFs that I have. With individual stocks where I get paid a dividend, there probably are some situations where I would prefer to have the dividends reinvested, but just with the brokers I use and so on, that's not really an option. So yeah, from the individual stock holdings, the money just goes to cash basically, and next time I want to buy a stock, I use some of that cash sitting there from dividends to kind of do so. So yeah, reasonably simple setup on that front. Next question here from Mahmood. Why didn't you calculate weighted average cost of capital and discount rate in your last DCF video? Yeah, very good question. I get this on most of the intrinsic value calculation videos that I do. Long story short, I basically subscribe to the Buffett school of thought on the way to approach discount rates and discounted cash flows. So Buffett has the view that, you know, cash that is produced and distributed from a steel company, for example, spends exactly the same as cash that might come from a technology company or a newspaper company or any other type of company. You know, people will use different discount rates typically based on how risky they view a company and how volatile its share price is, using beta and various things. But the Buffett Munger school of thought is that all cash from all companies spends the same, and risk really comes from not knowing what you're doing and not being able to, you know, get comfortable with projecting out the future cash flows of a given business. So for that reason, I tend to compare things all on a pretty level playing field with discount rates. I just discount things at the same rate pretty much across the board. I know that is not what they'll teach you in business school, and it's you know, not the common sort of MBA type approach, but that's the way that I kind of think about it. Like Buffett and Munger, I would much rather earn a lumpy 12 or 13% than a, you know, more steady 7 or 8%, for example. So you sort of see that reflected in just the simplicity of discount rates and discounted cash flows that I do. Question here from Banksy. Hi Tom, would you ever consider a place or room for speculative investment in your portfolio ever? Yes, I think I probably would. It sort of depends how you define speculative, I suppose. If I think that there's a good understanding in my head of kind of the odds of a particular investment working out, and maybe there's a high probability that the company goes down a lot or goes to zero, and there's a lower probability that the company goes up, but if it does go up, it goes up a lot, and kind of probabilistically thinking, you know, given the odds of downside and upside and the payoff in either direction, it still is a like statistically good bet to make. I think it is probably something I would do. I would just size it probably quite small. Again, it would depend on the situation. But if, for example, you know, I find a company where I think there's a 50% chance of it going to zero and a 50% chance of it going up 20 times, you know, statistically that's a good bet to make, and it probably does sort of deserve some spot on the portfolio. But that's all a fairly theoretical answer, to be honest. I can't think of a situation yet, at least, when I've actually done that. There's been a couple of situations where I probably could have, but I've ended up passing just because I couldn't quite get comfortable with the odds in either direction. But that's sort of how I think about it. Warren Buffett has said in Berkshire annual meetings in the past, for example, that he would bet on a coin flip if you know, the odds were 50-50, but the payoff was better than 50-50. I think that was, to a lot of people in the audience at that meeting, kind of like a weird take from Buffett. I don't think they had quite comprehended that that's the way he thinks. He's thinking about downside, upside, you know, probabilities versus the payoff in either direction. Munger, in a similar manner, many times has said we're not necessarily trying to bet on the best horse. We're trying to make the, you know, best investment, which doesn't necessarily mean you always buy the company that's most likely to succeed. You buy the company that's most likely to give you a good return, which that's kind of where price and odds and things comes into it as well. So to answer your question, in theory, yes, I would consider some space in the portfolio for a more speculative investment, but it would have to be sized appropriately, and it's not something I've really done to date. Next question is from J Sawyer Financial. What are the metrics you use to spot a high quality company? Yeah, it's pretty basic, I would say. A high return on invested capital or a high return on equity. and ideally the ability to keep reinvesting at those high rates for a very long period of time. So, if a company produces a 30% return on equity, but they have no ability to deploy any more capital, that's nowhere near as attractive as a company that earns a 30% return on equity and has a very long runway for growth. Maybe they're a restaurant chain that can clearly open, much more stores and can 3 or 4 or 5x their store count over the next decade. That type of thing is very attractive. That's really what builds wealth in long-term, stock investments, is the ability to earn high returns on capital and to kind of keep doing it again and again and again and just compound into, a big machine that earns a lot of money, basically. So yeah, in terms of quantitative metrics on company quality, pretty straightforward. That's kind of the way I think about it. Okay, next question here from MBM446. Hi Tom, thanks for all the detailed information you put in your videos. I really enjoy them. Thanks very much. All super investors and the punch card gang talk about protecting your downside first and the upside would take care of itself. How do you apply this principle in selecting companies and paying a reasonable price? I'm sure even Buffett has sold stocks at a loss in the past or held them for many years without much material gain. Doesn't that violate the principle? Phil Town's emotional rule of investing says that a stock would go down once you buy it. Doesn't that come with downside risk? Applying margin of safety would reduce the downside risk, but definitely not eliminate it. Can you please elaborate on this? Thanks again and keep producing great content. Cheers. Yeah, good question. I guess what we're trying to say there is that if you take care of the downside, the upside should take care of itself. Is essentially, if you were to calculate the intrinsic value for a company and you calculated that it was worth approximately $100 a share, just as an example, maybe you thought it's somewhere in a range of 80 to 120, but roughly $100. If you can buy that company in the market for $40 or $50, the long-term kind of chance of you losing money is greatly diminished versus if you paid $200 or $300 for those same shares. Now, that does not mean at all that the stock price can't go down to 30 or 20 or 10 or 5, and it certainly doesn't mean that you can't be wrong about your valuation as well. You might think that a company is worth 80 to 120, but you may be completely wrong about the future cash flows of the business, and maybe in fact it only is worth $30 or $40 a share. So that's kind of what we're getting at there, is if your analysis is correct and you're buying something at a big discount to intrinsic value, the likelihood of long-term loss, assuming that you're correct about your $100 valuation, is greatly diminished. And if the market over time agrees with your valuation, then the share price might go from 40 or 50 back up to roughly 100 or about what you valued it at. So that's essentially all that I think the super investors are saying, and all that Phil Town and the Punch Card crew are saying. So you can definitely be down mark to market on your investments and still be right in the long term. I've had stocks where I've been down 50% and they've over the long term turned out to be doubles, so they've kind of gone up 4 times from the lows that they got down to after I'd bought them. So yeah, there will still always be short-term downside risk, but if you're right on the business, you should do okay over time, assuming the market eventually agrees with you. But mistakes are going to be par for the course. You are likely to lose money over time in investing if you're picking individual stocks. That's just how the game kind of goes. Even the best investors in the world lose money from time to time, and even the best investors in the world, can buy a stock, hang on to it for several years, and have very lackluster returns. So if we can learn from those mistakes, that's always nice, but that's the general principle that we're talking through there. Okay, next question is from Freeman61312. Hey Tom, I know Buffett, Munger, as well as Bryce Spear attribute a lot of their success to having a good friend to use as a soundboard for ideas. Do you have a trusted person to share ideas with? If so, how do you meet them, and what unique perspectives do you each bring to the table? Yeah, sure. I have a few people that I talk to about stocks reasonably regularly. Most of them I've met through YouTube, so whether they're on the Punch Card Show or they're people that I've met through the podcast or a range of different things. There's lots of different people I talk to, and it probably varies depending on what company I'm looking at as well. Often there'll be a reasonable amount of overlap with me and someone else in terms of like we have a shared interest in a given company. So that can both be good and bad. You know, if that person's coming in with quite a positive view of the company and you're a little more skeptical initially, that can be both good and bad. You've got to take what people say with a grain of salt and so on. But yeah, I do have a few people I kind of talk through ideas with. I certainly make the final decision, of course, and I have checklists to make sure investments are meeting all the points that I want them to meet before I put hard-earned money to work and so on. But yeah, to be honest, most of the people that I share ideas with, I've really met online through doing this YouTube channel or doing the podcast or what have you. If you don't have that luxury, I've also found the likes of the Value Investors Club very good, or just speaking to people on Twitter who are sharing their ideas. You know, you can just search stock tickers on Twitter and find pretty intelligent people talking about, you know, different companies that you might be interested in. It's pretty rare that I type a ticker symbol into Twitter and don't find someone talking about it, even if it is kind of an older tweet. So that's the way I've tended to approach it. At the same time, I also have investments in my portfolio that is, you know, 100% my own work, and I've basically never talked to anyone about. So it really just depends on the company. Occasionally you'll look at weird stuff that no one else you know is interested in, and occasionally you'll talk about really well-known companies that a lot of people are interested in. So yeah, I definitely do try to talk to people if I can, but you know, at the end of the day, I've got to be the one trying to think through the situation rationally, and of course, I've got to be the one to make the final decision. Next question is from @ValueHunterInvesting. Just wanted to hear your take on this. It was a question asked of me a while back, and at the time I struggled to provide a good enough reason. As value investors, we need to look at how much cash we can get out of a business to judge how much to pay for a business. Value investors also love Berkshire, who never pay a dividend. I know it is ownership in a real business, and we can sum the parts, but all that aside, if Berkshire never pays a dividend, doesn't that mean an investment in Berkshire is simply a hope that the future will be brighter and that one day someone else will pay us more for the shares than we paid in the first place? Yeah, good question. I guess, yeah, Berkshire actually, I think, did pay a dividend back in like the 1960s. Buffett has said it's a massive mistake because he could have invested that cash and turned it into much more intrinsic value, you know, by today in 2023. But yeah, Berkshire, with that one exception, has never paid a dividend, but its ability to distribute cash has grown immensely over the years, and that's how people are valuing Berkshire. So just because they've never distributed any cash definitely doesn't mean that there's no value. Their earning power has gone up year after year after year, and their ability to potentially distribute cash has grown, and that's why the intrinsic value has gone up. So far, Warren Buffett has easily met the test of creating more than $1 of market value for every dollar retained. So it's made a lot of sense for Berkshire to just hang on to the cash. If that changes at some point, we might see sort of the capital allocation framework around dividends and buybacks and so on change a little bit at Berkshire. But yeah, that's basically the explanation, is that in the 1960s, Berkshire had the ability to pay out some level of cash if they wanted to. Their ability to distribute cash today is much, much greater, and that's the reason that the stock price has gone up. It's not because Buffett's got just more famous for some reason, and you know, people are willing to pay more for the shares just to, you know, be in the same company as Warren Buffett or what have you. It is that the underlying intrinsic value and ability to pay out cash at Berkshire has grown a lot. Okay, let's take maybe two more questions here. This one's from Tom Maslin 1500. Hey Tom, did you ever pull the trigger on any coal companies? I've been buying into an ASX listed coal miner as I see coal being around for a long time. Valuations are currently very attractive. Keen to hear your thoughts. Thanks, Tom. No, long story short, I didn't. It's a space I looked at for a short period of time. I guess that was earlier this year. Yeah, valuations look very attractive. They were going to be paying out huge dividends. Some of them were doing monster buybacks as well. It's outside of my circle of competence is the short answer. I don't really understand the different types of coal. I don't have a particularly strong view about the long-term, you know, price of coal or how the coal market really works. So the numbers looked pretty compelling in some cases, but I just don't understand the business. It's outside of my circle of competence, and that's the first filter I have on my checklist. So it did not make it through that filter. Okay, let's do one last question here from Quant Compounder. When will we see the OG punch card crew all together live on a stream again? Yeah, good question. I think probably by the time this Q&A video is out, there should be a post on the punch card investing YouTube channel sort of community page. There's basically been sort of a change of ownership on the punch card channel. So it used to be 5 of us, 20% ownership each. It was me, Frank, Brad, Karan, and Jack. That's changed a little bit. You know, the 5 of us over the years that Punch Card have been going have all had various changes in priorities and in life circumstances and so on. So for me personally, I've made the choice to focus a little bit more on keeping consistent content coming out here on the Investing with Tom channel and on the podcast channel. So Jack is basically the sole owner of Punch Card at this point and will be kind of running the channel and inviting guests and hosting the shows as he's done for a long time and all that sort of thing. The rest of the kind of original Punch Card crew will certainly still make appearances from time to time. Hopefully at some point in the future we can do a show where we get the gang back together and kind of have the original crew on there. But it wasn't a particularly like lucrative show financially or anything like that, so everyone was reasonably comfortable in the end, kind of handing the reins over to Jack and allowing him to keep pushing it forward and hopefully grow Punch Card out into the future. But yeah, I'll still be on there from time to time for sure, but probably a little bit less, or almost certainly less than I have been in the past. Okay, so those are all the questions we have time for in this video. Thank you very much to everyone who did ask one. Like I said at the start of the video, if you would like to get a question potentially answered in a future Q&A video, turn notifications on for the channel and keep an eye out for my community posts. About once a month is kind of when I try to do these videos, so roughly a month from today or a little bit less than that. Just keep an eye out for a post up there, get in quick and ask your questions, and hopefully you can have one answered on one of these videos. But that's it from me for this video, and I'll see you on the next one. Cheers.